Hello and welcome back to our second lecture video dealing with Chapter 14, the cost of capital. So we already looked at the cost of equity. We saw the two acceptable approaches we could use. Now we're going to look at the cost of debt. Okay, so the cost of debt, or R subscript D, is the interest rate on new debt. Okay, we can easily estimate this interest rate on new debt. How do we do that? Well, first we could use the yield to maturity on outstanding debt, or if we know the bond rating, we can look up rates on new issues with the same rating. Okay, so again, very kind of important to point out. Last semester, when we were calculating bonds and whatnot, we considered the coupon rate. Okay, keep in mind that the coupon rate was the cost of debt for the company when the bond was issued. Okay, however, now we are interested in the rate we would have to pay on newly issued debt. Okay, so there could be a difference between the coupon rate and what we have to pay now on newly issued rate. Okay, so if you notice the last slide, it's very important we understand this. The cost of debt is not the coupon rate. Okay, so again, we're gonna determine that cost of debt to be the interest rate on new debt, and we have to find that. Again, there's two easy ways to find it. Number one, we can estimate the cost of debt using the yield to maturity on outstanding debt, or if we know the bond rating, just look it up. Right? Pretty easy. Okay, so let's look at a quick example here. Okay, so let's suppose we have a bond issue. It's currently outstanding that has 25 years left to maturity. Okay, the coupon rate is 9%. The coupons are paid semi-annually. Today, the bond is selling for $908.72 per bond, or per 1,000 bond. We need to figure out what is the cost of debt. So guess what we got to do? Got to pull out our financial calculators, and we have to figure out the number of periods, the payment amount, the future value. We know the present value. We need to figure out what the interest rate is. Okay, so we're going to plug it into our financial calculators, compute I of Y, we get 5%. Now we need to figure out the yield to maturity, right? If it's 5% per period, we got 2 periods, right? Because it's semi-annually. So we need to multiply, that interest rate, or that I of Y, by 2, because it's, again, semi-annually. So we see that the yield to maturity is 10%. Okay. If you do not have a financial calculator, it's going to be a little bit more difficult, because you're going to have to use some trial and error to find that yield to maturity. Okay. Okay. So now we're going to look at preferred stock. Okay. The cost of preferred stock. Now, remember, when it comes to preferred stock, we are generally going to pay a constant dividend each period. So that means that preferred stock is going to be considered to be a perpetuity, right? Remember that from last semester. So we can rearrange that perpetuity equation, and we can get the cost of preferred stock. How do we rearrange it? Well, the return on preferred stock is the dividend divided by today's price. Okay, or today's price, price of today, right? P subscript 0. So let's look at an example. Okay, we got a company. They got preferred stock. They got an annual dividend of $3. Current price is $25. What's the cost of preferred stock? 12%, right? Take our 3, which is our dividend, divided by the current price, or the price today. If I were you, I would know this. Okay, know how we, actually, let's go back one. Oh, sorry. I would know this. Know that preferred stock is a perpetuity. Okay, so those might be 2 questions on your pop quiz, right? Preferred stock is a blank. Well, you know it's a perpetuity. And I may ask, hey, how do we calculate the cost of preferred stock? Well, it's easy. That's that return of preferred stock equals our dividend divided by P of 0. Okay? So let's look at the weighted average cost of capital, right? The weighted average cost of capital. What in the world is this? Okay. Well, basically, what we're going to do is we are going to determine pretty much the capital what the capital structure weights are. Okay. So what we're going to do is we're going to use the individual cost of capital that, again, we've computed previously to get average cost of capital for the firm. Okay, so all that stuff we did for cost of equity, for the cost of debt, for the cost of preferred stock, we're going to take all that and average it. Okay, so again, this average that we're talking about, this is the required return on the firm's assets. Again, it is going to be based on the perception of those risks, right? Whose perceptions? The market's perception of the risk of those assets. Okay. And again, we're going to determine those weights by how much of each type of financing is used. Okay. So it's really not that hard to do. So the first thing we need to know is that we have some notations that we need to learn. Okay, if I were you, I would make sure I know these for Monday, because we're going to get into calculating WACC and we're going to work on it and talk about it. Okay, so I would know the notations of what they are. Okay, so it's important to note that for bonds, we have to find the market value of each bond issue, and then we add those together, okay? Keep in mind, preferred stock would just become another component of the equation if the firm is actually issued preferred stock. Some firms have it, some firms don't. That's okay, okay? Just keep in mind that if they have preferred stock, it's just another component of the equation, and we're going to get into that in a second here. We're going to ignore the current liabilities in our computation here. However, if we have a large amount of current liabilities, if that's a big portion of our capital structure, okay, the current liabilities, we would include those, okay. So let's go over this notation real quick. E, that just stands for the market value of equity, right? Okay, well, we're looking here at the number of outstanding shares times the price per share. That's easy. D, what's D mean? It's the market value of the debt. How do we calculate that? Well, the number of outstanding bonds times the bond price. Then we have V. What's V? It's the market value of the firm. It's calculated as D, which is the market value of debt, plus the market value of equity, okay? Then we have weights, right? There's 2 weights we got to worry about. The weight of equity versus the weight of debt, okay? So how do we calculate the weight of equity? Well, it's simple, right? We take E, which is the market value of equity, divided by the total market value of the firm. That's the percent of the firm that's financed with equity. We do the same exact thing with debt, okay? the weights of debt, you take the market value of the debt divided by the market value of the entire firm. That tells us the percent of the capital structure, or the percent of the firm that's financed with debt. Okay. Very important slide. This is slide 20. If I were you, I would study that, because I guarantee there's going to be maybe 1 or 2 questions on your pop quiz that comes from this slide. Okay. And again, we're not sharing this info with the class, right? These are all bonus points, or this pop quiz is going to be bonus. Okay. And it's because you watched it, you get bonus. All right. All right, so let's look at an example here of the capital weight structure, okay? Very easy. Let's suppose you have a market value of equity equal to 500 million and a market value of debt equity, which is 475 million. Well, what's our V? What's our total market value, right? Or what's the combined market value of the firm's equity and debt? Well, it's 975 million. How'd you get that? Super easy. I took the market value of the equity plus the market value of the debt. I added them up. Now, what percentage of the firm is financed with equity versus what percentage of the firm is financed with debt? Very easy. We take the equity value, which is 500 million, and divide it by the total value of the company, which is 975. Basically, it's 51%. How much of our company is financed with debt? Well, again, we do the same thing. 475 divided by 975, we get about 48%. Okay, so not too difficult there. Now we need to worry about taxes. So we're going to talk about taxes and the weighted average cost of capital. Okay, so basically we're going to talk about taxes and WACC. That's really what we're going to talk about here. Okay, so it's important that we remember that after-tax cash flows require an after-tax discount rate. So we're going to let T subscript C denote the firm's marginal tax rate. Okay, it's the marginal tax rate. Then we're going to calculate the weighted average cost of capital, factoring in taxes. Okay, how do we do that? Very easy. We take our WACC, or to calculate our WACC, we take our percentage of equity times the return on equity, right? Now don't get confused, because what did we say way back in the beginning not to get confused on? Do you remember? I get even though I'm home doing this, I can still sense you guys just staring at the screen, being like, I don't know, I can't remember. So remember, required return is from the investor's point of view. Cost of capital is the same return from the firm's point of view. So just because we're saying required return, right? Or just because we're saying return, we're talking about the same thing. We're talking about that cost of capital, okay? So what do? We take the weight of equity times that return plus the weight of the debt times that return, and then we multiply that by multiply that by 1 minus T subscript C. What's that? Well, remember what we said here. We need to take into account, or we need to account for the fact that we have to have an after-tax discount rate. So the after-tax cost of debt is going to be R subscript D times 1 minus T of C. Okay? Keep in mind, we're going to work on this in class together. Right now, all I want you to know is to understand this equation. Okay? So, remember, we're concerned with this after-tax cash flow, right? We got to consider the effect of taxes And certain costs of capital, or let me rephrase that, taxes have different effects on the various forms of cost of capital, okay? Interest, right? It's an expense. It reduces our tax liability, okay? So, in order to calculate that, or in order to incorporate that, basically what we're saying is, hey, this interest expense, it's actually reducing our taxes, which reduces our cost of debt. So we need that after-tax cost of debt, okay? I would know this equation too, right? And I would actually know all this because this quite possibly could be a question on your bonus pop quiz, okay? Let me think, what else do I want to say here? I think that's it. Let's look at a quick example, okay? So we have equity information, we have debt information, right? What's the information? Well, we got 50 million shares of stock, we've got $80 per share. The beta is 1.5, market risk premiums equal to 9%, risk-free rate of return is 5%. Debt, hey, we got $1 billion in debt outstanding, okay? That's our face value, so we'll need to, multiply the number of bonds times the price. They're telling us that's the face value, $1 billion, right? They give us the current quote. It's 110, right? Or $1,100 per bond. They give us the coupon rate, 9%, telling us it's semi-annual. We got 15 years to maturity, and they gave us the tax rate. Our marginal tax rate is 21%. What do? Very simple. First, we got to figure out what's the cost of equity, right? We already said we're going to memorize that equation, right? We have our 5. What's our 5? That's our risk-free rate plus beta times our market risk premium, okay? So right off the bat, you need to recognize, what are we using? We're using that SML approach, right? Or we're using the CAPM model, right? That's the first takeaway. So you got to know these equations, okay? Now we got to figure out the cost of debt. Hey, that's easy peasy because I got one of them fancy financial calculators, right? Calculating for the interest, the return on D, or the return on debt, excuse me, is 3.927 semi-annually, so we got to multiply it by 2. I get my cost of debt. But hold on. Remember, there's interest in this number, in this return, right? Interest is tax deductible for us. So we need to calculate the after-tax cost of debt. That's why I said, hey, this might be in a question, right? So what is our after-tax cost of debt? Well, it's we'll just say 6.2%, okay? Again, we take our return for our debt, which we already figured out for our cost of debt, 1 minus the tax rate, or the marginal tax rate, we get 6.2, okay? Not done yet, almost, not quite, right? We got to figure out the WACC, right? So before we do that, we got to figure out, what are the capital structure weights? What's our equity? Well, 50 million divided by 50 million times 80 gives us 4 billion. Debt gives us 1 billion times our current price, which is 1.10. We got 1.1 billion in debt. What is our total market value? The 4 billion plus the 1.1 billion gives us 5.1 billion. Now I can figure out my weights, okay? Weight of equity, again, I take the 4 billion divided by the 5.1. I get 78%. For debt, I do the same exact calculation. D divided by V, or 1.5 divided, sorry, 1.1 divided by 5.1 gives me basically 21%. So now I can calculate my WACC, right? What is the WACC? I take the return, or I'm sorry, the weight of equity times the return, right, which I have right here. I take the weight of the debt times that after-tax return. My weighted average cost of capital is 13.38. Okay. Don't worry about Eastman Chem. We'll do some problems in class. Okay. Again, if I were you, just to kind of review, so to speak, I would know this slide. This is slide 30. I would know slide 31, cost of debt. I would know slide 32, which talks about WACC, or the weighted average cost of capital. Okay. When we come back in our next video, we're going to look at divisional and project cost of capital. Okay, and we'll talk about what that is and how we calculate that. So before we move on, don't forget what's really, really important here, right? We got to know how to calculate WACC. There we go. We got to know how to calculate the average cost of capital. Okay, we said that we have some notation and some weights. We need to know what those notations are, how to calculate those notations, and how to calculate the weights. You might get a couple questions on this on your quiz, okay? Don't worry about actually running the numbers. We'll work on that together, and we'll talk about some effects of those numbers, okay? You should definitely know, especially for a little quiz or a little bonus quiz, the fact that interest expense reduces our tax liability, so we actually need an after-tax cost of debt and how to calculate that, okay? You should know the WACC equation. WACC equation, well, that sounds weird, okay? So when we come back, we're going to look at, again, divisional and project cost of capital. So tune back in for that one.